All right, a very good evening, everybody. Welcome to the live webinar on Trump 2.0 Market Shifts and Trading Opportunities. I'm Ming Hui from Flip Nova, and tonight's webinar is held in collaboration with CME. And speaking to us will be Mr. David Ng, proprietary trader at Iceberg X. Before I pass the time to David, please be reminded that if you have any questions throughout the course of the webinar, you can drop them into the questions box and we will address them during the live Q&A session towards the end. And now, without further ado, over to you, David.
Yeah, hi. Thank you, Minghui. I'm just going to share my slides. Just do let me know if you can see my slides in full screen mode.
Yes, that's perfect.
Yeah, okay. Thank you. Yeah, thank you everyone for joining in. And I believe hopefully you have your dinner. And I think also just like to take this opportunity to thank Philip Noah as well as CME for inviting me to speak on this important topic, and it's very timely given that we are just a couple of days into new administration under the Trump 2.0. So definitely, there's a lot of we have witnessed a lot of volatility in the market. Whether you talk about commodities or equities, especially in the US space, it's clearly it's going to be a volatile period as we enter into the new administration of Trump 2.0. So just before I start, just like to put a disclaimer out. I think any materials that's presented here today is purely for educational purpose. So no, I think if you are new to the futures market, dabbling in the futures market, it does involve a lot of risk. So make sure you are well educated, get more resourceful information. I believe Philip Noah in this sense can help you with that. And obviously, if you are in the market now, is you definitely witness a lot of volatility in the market. So make sure you have a plan in place. Later part in the later webinar deck, I'll be talking about the importance of having a trading plan and the discipline to follow those trading plan. I think is vital, especially during this period. So ensure that you have a way to manage your loss and measure your loss accordingly, because I think ultimately when markets gets very volatile, it literally can be a make or break for a new trader in the market. Now, in the next half an hour to 45 minutes or so, I'm just going to cover on mainly on how we're going to see the new Trump 2.0 term coming to the US market. I think especially in regards to the equity space, you have been trading the equity indices, you probably have noticed that US equities is actually hitting all-time high, pretty much week in, week out. The key question is whether can this rally still sustain itself, given that there's a couple of headwinds that's coming. And I think unfortunately that we as a trader we have to brace this kind of volatility. So importantly, I think there's few key things that we need to watch out and look carefully after, because ultimately this can actually sway the fundamentals of the U.S. economy. Now, I think with Trump 2.0, we have seen how Trump 1.0 has actually caused a lot of chaos and havoc in the market. I think Trump 2.0 may be slightly different, but I think ultimately we still have to acknowledge the fact that it's going to be a very volatile period. Now, given this discount the Trump administration, we also have to account that there's also other potential headwinds this year, especially to do with geopolitics and obviously trade war, potential trade war that's going to happen between the key countries, U.S. trading countries. So I think these are the things that we need to look out at, and I think in this regards, it's definitely going to be causing a lot of turmoil in the financial markets. And It's any opportunity in the market, there's always an opportunity for trader to capitalize. The key thing is that we have to make sure how we identify those opportunities using certain technical strategies that we can employ, especially during these volatile periods. Now, I think not only equities is having the impact. I think Trump policies will be a major impact, not only for equity space but also for commodities market. So if you have been in the commodities market, be it the energy or be the grains market, be prepared. I think this year we're probably going to see a lot of changes, and I think as news and policies become more firm and there's more clarity, and it's definitely going to ride the markets. And I think if you are in this space, again, this is a factor that you have to consider if you're trading the commodities market. Last but not least, I think I'm just going to cover on certain technical trading strategies, especially to do with trend. So markets are trending in quite a clear manner. So obviously there's pocket of opportunities where you can actually use technical trading tools, especially the trend trading tools that can help you to actually assist you to find entries and exit strategies in the market. Now, importantly, I like to emphasize again, with every trading plan, you must have a way to measure your loss because that's a key thing when it comes to sustainable trading in the future. So really, I think is I just want to emphasize the importance of having a plan to get you out if the market go against you. Now, I just want to show you this chart. This chart points to you basically the three major U.S. indices. One is basically the Nasdaq, the S&P 500, and obviously the Dow Jones Index. As you can clearly see, both of these three major indices is actually reach an all-time high level. The key question is that can this rally still sustain itself in months to come? Now, if you look at technical per se, it looks like the rally still has a bit of legs, but I think there's certain indicators are pointing to you that probably the trend has slowly reached its exhaustion. So be careful. In any rising market, they're bound to have a period where prices retrace. And during those times, I always get this a lot. Especially if you are trend trading the market, if the trend is clearly an uptrend market, always find position for you to long rather than short. It's never easy to try to time the reversal in the market or the change in trend because trend can persist for quite a long time and it can be a stubborn trend. So as long as the trend is still intact, the trend is still an uptrend market, always find a position for you to long the market at a specific entry. So I think any retracement in any of the three major US indices could be an opportunity for you to take a long position in the market, assuming that the fundamentals are still pretty strong and solid enough. Now, just touch a bit on economic fundamentals. I think US this year, despite having a new, having Trump coming back in the second term, I think generally the outlook still looks pretty well. I think IMF just came out with their own forecast just a couple of days back. It seems like they're actually quite positive for this year. Now things can change. I think the major drag will always be China, because China is suffering from not only I think the problem of deflation but also severe housing crisis. So I think as long as those persistent headwinds are still there in China, I think China will be a major drag. Now I think US on its own is going to be interesting. I think in terms of fundamentals, they are actually pretty solid. The only thing that is actually quite worrying is the major thing that I will see it repeated this year is always inflation. There's talks in town that inflation is probably biting back harder this time, and if that's the case, then that will have a major impact on the interest rate. And coming from Federal Reserve, this year we anticipate that interest rate in US is probably going to hit higher instead of lower, which can actually be bad for the equities market in the short term. Now, just looking at the scorecard in the first term for the Trump presidential term, you can clearly see that I think Trump is using the equities market as pretty much his scorecard. So if he wants to do well in the market, or he wants to show that he's actually doing well as a president, I think equities market is a good reflection. So you can clearly see, I think, the first term from 2016 right until 2020, you can see the markets, especially US markets, actually hitting all-time high. If you discount the fact that if you discount pandemic effect in the early part of 2020, so pretty much I think in I think Trump's coming back in the second round, equity market will be a major focus for him. I think not only that, if you just look at unemployment numbers and the labor force numbers, employment market during the Trump first term is actually a very good picture in the sense that unemployment was actually hitting an all-time low during that time. So I think I think the key focus for Trump is always about the economy, it's always about the market, and I believe that it's very optimistic in the sense that he will do anything that to prop up the market. So in a sense, I think it's safe to say that to see a very a sharp sell down in the market is quite unlikely. I think Trump will do his best to try to maintain a positive vibe in the market, especially when you have equities, U.S. equities market hitting all-time high levels. Now, in terms of economic growth, you can see that in the first 4 years term in during the Trump presidential election, you can clearly see that U.S. GDP growth is clearly on a positive side. showing you the significant gains in the market with a strong fundamental footing. Now, again, if you discount the pandemic factor, I think during Trump era is indeed in the first era, is actually he did performing well when it comes to U.S. Economic growth. And again, I think it's always an emphasis of the economy, the markets, and the businesses. I think that's his major focus. And this time around, coming back for the second term, I think this will be his priorities areas again. Now, I think this is the third day into the new administration. You can clearly see, I think Trump is very, you know, is very aggressive on his first day, trying to sign so many executive orders, trying to reverse some of his previous administration decisions and legislative actions. Now, I think if you look at some of the key major areas that he's actually trying to deploy, I think mainly it's always about immigration. Immigration is always a hindrance, especially when it comes to U.S. policy. And I think with this new executive order, it actually give an impact when it comes to immigration. Now, immigration policies will have a big impact when it comes to you talk about commodities in general. Why is that so? Is because if you look at labor force, especially in the grains market, majority of this labor force comprises a lot of this foreign immigration. So if to reverse the flow, if US decided to send back some of these foreign immigrants, I think that's going to be a short supply in terms of labor, especially in the commodity space. And that regard, that means which will have to go higher to compensate the decline in supply, and therefore that will push grain prices higher. So I think ultimately, I think with such a policy in place, it's generally going to accentuate a higher inflationary level, especially for the US market. Now, that aside, tariff is also another important topic, and it's a hot topic. You just look at what is announced yesterday. Trump mentioned that he's going to impose a 10% punitive tariff on China, coming 1st February, and 25% on Canada and Mexico. Tariff is a very bad, trade weapon, and unfortunately, I think this will just aggravate the trade war between US and China, and not only US and China. There's also other borders, especially Canada and Mexico. Now, how that will turn out ultimately, it's going to raise overall prices, whether it's on US or other importing countries. So inflationary is going to be a major concern with this kind of policy in place. Inflation levels is something that we need to watch out, because that will have a lot of repercussion towards interest rate decisions by Federal Reserve. So tariff is one hand, and we have immigration. Now, I think other things that is also worth mentioning is the policy on mineral energy. So Trump is a very big believer in crude oil. So I think he have actually signed an executive order to actually allow more exploration in the oil and gas sectors. So that means US definitely in the coming months will be pumping more supply of crude oil into the market. Now, with high oil price environment, as what I'm seeing now, it's not to say too high. It's comfortable enough. I think that will probably help with US budget surpluses. Now, other than that, I think another key area that's also looking quite closely is technology. In terms of technology, I think the race to become the number one in the technology race is always very competitive, with China closely coming from behind. I think US is trying to gain that dominant spot, and to do that, there need to be a lot of investment in the AI field. So I believe with Trump this time around, acknowledging the fact that US is slipping quite fast in the AI space and AI race. So I can you can clearly see that the emphasis and focus will definitely be in the AI space and market. Now, how will this relate to market in general? If you just look at how tech counters, or the so-called Magnificent Seven, that actually prop up pretty much the US equity indices, I think that will continue, even though valuations are stretched, because I think the team and sectoral play right now is the AI team. I think that will really be something that is going to drive markets higher, or be a level of support for the US equity market in general. Now, if you just look at it, despite majority of the three major US indices hitting all-time high levels, record levels. Now, if you just look at Russell 2000, which is an index that actually measures the top 2,000 companies in US, you can clearly see there's a bit of diversion there. That means some of these 2,000 companies that's actually not in top 10 or 20 companies in the US market, actually they've the performance are pretty dragged. So in a sense that we don't see the kind of market breadth, don't see that rapid increase in across major sectors. It's really concentrated on only the AI and the tech sectors for now. So when you have such a market breadth that is actually very narrow, there's bound to be a correction that's happened in time to come. So watch out. I think with market breadth that is so narrow, where the concentration of rally is only on selected few companies is going to be quite a risk. When if the correction do comes in place, especially to all these magnificent seven companies, the correction can be very steep. Now again, the overall trend of the market for the US indices in general is still an uptrend market. So any retracement is probably could be seen as an opportunity for you to long the market rather than shorting the market. So this is what I mentioned. If you just look at the breadth, this is measuring the companies in terms of technical breadth, where companies that's trading below the 50 period moving average. So normally it's a good indication if majority of the companies are trading below the 50 moving average, and however the equity indices are continuing to gain higher momentum, usually is a diversion, and once that happens, normally you start to see there's weakening in the overall space. Now we can see a slight reprieve in recent weeks. We see that slowly the breadth is actually coming back to its alignment. We can start to see more companies are trading above the 50 moving period, 50 days moving average. So the key question is, if as long as we can start to see more companies trading above its 50 period EMAs, that's a good sign. But the moment when companies starts to fall off the cliff and trading below the 50 days moving average, that's usually a sign of concern. And we saw the first indication, I think, was early part of this month. True enough, we start to see that the index starts to taper off from the high. But then again, the recent rally actually brought back up some majority of the companies back above the 50 period moving average. So the key thing to watch out is how many companies are actually trading above the 50 period moving average. And once the breadth starts to narrow, when it starts to see companies falling below the 50 period moving average, that's usually a sign that market maybe a potential sign the market is heading for further downside. Or the rally is probably going to be exhausted in time to come. Now, I think one of the key things we have to acknowledge is that whenever they've seen as if we look back in the first Trump presidential election, presidential term, you can clearly see the market volatility has actually been raised. This is basically a week's index, which is a barometer of fear in the market. So you can clearly see, I think, fear week's index are quite clearly elevated. The normal range for weeks usually trades around 17 to 20 points, but anything above 20 points usually indicates there's fear, or rather there's hedging activities going on in the market. Now, be prepared. I think going into 2025, at least the first 100 days is very critical. Trump will definitely cement his policies, or stamp his policies on his key areas, and that will create a lot of volatility in the market. So VIX is definitely going to be more something that is a gauge for volatility in the market. And as long as VIX stays above 20, that tells you that market generally is very volatile at that point in time. Now, looking at fundamentals in the U.S. economy, I think everything looks, in terms of jobs growth and job momentum, is still quite positive. There's no sign of breaking or cracking in the jobs market, and I think this is crucial. So as long as a lot of indicators are pointing that businesses has lost its confidence, and there's not much optimism in the market. But I think key thing is that looking at job reports and job markets in totality, you can clearly see there's still positive momentum that's still in place. So as long as Federal Reserves are watching this closely, if the job markets are still good, it's still positive. Actually, there's no need to really cut interest rate, or there's the urgency to cut interest rate may not be that so significant. As long as the job markets are still resilient, it's telling you that generally the economy is still doing well. Now, I think the major thing to really look at is inflation. Now, I think inflation is in the past 2.5 years we've been fighting inflation aggressively. I think Federal Reserve has actually used all its arsenal by hiking interest rates in such a rapid manner in such a short span of time. That actually bring down inflation levels right down to comfortably below 3%. But the key thing is that in past couple of months, we slowly start to see signs that inflation may be actually inching higher. It's stabilized, but I think there's momentum that inflation may actually poised to go higher. Now, if that's the case, with job markets that are still sustaining very strong momentum, inflation concerns is definitely going to be back on the table, and that means Federal Reserve is going to be very cautious. Now, everybody is expecting 2025 should continue the interest rate cut, as what we had seen late last year. Now, I think that has slowly shifted. I think probably now the consensus, if you just look at Federal Reserve consensus, probably looking at instead of cutting interest rates, probably going to see a round of hiking interest rates. And if that happens, that will really ride the markets, especially equities markets. You have high interest rate environment, normally that generally may not be that good for the equity space. So I think inflation is going to be a key area to watch out, especially for US market and especially during a Trump era, because we have seen the first time, with trade war, with tariffs in place, now definitely now with the immigration policy in place, I think that's create a lot of inflation environment for the market. Now, just showing you commodity prices. That's why I'm saying, this year 2025 is quite crucial to watch. Why is that so? Because you can see some of the key commodities, prices of certain commodities actually quite elevated. If you just look at coffee, cocoa, sugar, these are bread and butter. Majority of these, prices of these commodities actually been on the rise. So I think that will create a bit of problem when it comes to trying to control or dampen down the inflationary mode. So as long as commodity prices are quite elevated, I think that's going to be a sign that inflation is quite going to be quite persistent. And if it's sign of inflation going higher, I think that's going to trigger Federal Reserve to probably be thinking twice whether to still cut interest rate or probably going to put on hold and start hiking the interest rate higher. So you just look at it. I think if you just look at the yield levels, it's really quite reflecting that inflation is back, and the concern of inflation is back. And generally, if you just look at the Fed dot plot, we can clearly see that a lot of consensus market is probably this year we probably see max probably a one rate cut, followed on by possibly a one or two cycle of a rate hike. Now, will that materialize is really a question on what kind of inflation levels we are seeing in the next couple of weeks or months. So if you are trading a US market, you have to watch out inflation levels because that will be very key on how the Federal Reserve is going to maneuver its interest rates going forward. Now, the key question is that when Federal Reserve starts cutting the interest rate or start employing the cut interest rate cycle back in second or third quarter last year, now generally the rates or the yields will start to come down, probably between a month or 2 months or so. But you can clearly see, I think once the sentiment has changed, once market expecting that inflation is going to be something of a concern this year, yields actually remain quite elevated. So it goes to show, I think this time around it can be very different. It's telling you that Treasury is reacting quite differently to what people is expecting, and generally I think it's factoring a higher inflation environment. Now, rates generally low interest rates are usually very beneficial for economy, but usually tells you that economy is not doing well. That's why Federal Reserve is cutting interest rate. But when you have a high interest rate and it's persistently, stubbornly high for quite a long period, normally if you have if in an economy which is inundated with a huge amount of debt, it could be a problem. It could pose a potential problem. So high interest rate environment for a long period of time may not be a good thing. And I think one of the key areas to watch out is always, if you look at economic data, is look at US housing stats. So housing stats, as long as they don't show any sign of further deterioration, I think that's still good. Economy still can go on smoothly. But once I think house data shows or points to you weaknesses, especially in the mortgage segments because of elevated interest rate environment, consumer couldn't absorb such a high repayment, monthly repayments. I think that's usually tells you that economy will probably have an impact thereafter. So I think these are some areas to watch out, especially when you have interest rates. US interest rate is actually quite elevated during this point in time. Now, this chart shows you the US margin debt. I think this is a very useful chart. Basically, it tells you how much of a consumer is taking up margins to purchase stocks in the equities market. So normally, if the markets are doing well, a lot of consumers are piling into debts, or rather interest rates are cheap or low. Normally, consumers will prefer to use margins to purchase their stocks. Now, in recent times, we see that even though rates are going higher, the cost of financing for margin debt has actually been going higher, but I still see that consumers are still piling into debt financing using margins to purchase stocks. That's usually be a good telltale signs that majority of people are expecting the rally in the US market can still continue. Now, the first sign is that usually when consumers starts to taper off, or when rates are too high, the refinancing costs are way above their returns they can get from the stock market. That's where they start to slow down on their margin debt. And that usually, when margin debt starts to decrease, that usually tells you the rally in the market is probably going to be quite peak. And that's usually the first sign that probably you should see a bit of retracement in the equities market during that time. So watch out. I think margin debt is usually quite a good tool or good indicator to look at, especially on a gauge where the rally in the market can potentially be exhausted in near future. Now, as I mentioned earlier, I think right now the US market is very concentrated to only a few selected companies, especially the tech companies. Now, that's maybe is not a good thing in the sense that you're having too much of concentration risk. Now, like I said, valuations can be way overstretched, but market always runs on supply and demand forces. As long as people are still demanding tech counters, and therefore I think tech counters will still be in favor despite the high prices you are seeing. Now, the key question is that the percentage of, especially this Magnificent Seven, when it comes to the S&P 500 component, is actually gaining higher and higher. That means now, on estimate, is pretty much about 35 to 40% of your S&P 500 movement is actually contributed by only 7 companies in the whole 500 companies index. So that's very crucial and very concentrated. So if there's any underperformance by any of these 7 companies, that really will change the market dynamics. So you really have to watch out, how these 7 companies perform going forward. Now, obviously, they are in a very sectorial theme right now, which is the AI and technology space. So as long as there's still good narrative about this sector, the rally can still continue. But as long as once earnings are not justified, or rather there's sign of slowing down in any of these seven companies, the momentum of these 7 companies, I think that's usually be a good indication that the market pretty much has probably peaked, or the rally that we're seeing is probably exhausted at that during that point in time. Now, I just want to touch a bit on soybean. I think if you are looking at Trump 1.0, you can clearly see soybean was a major factor in the trade war between US and China. Now, I think almost 8 years has passed since then. You can clearly see US, in terms of market share for soybean, in terms of production, they are pretty much still second in the world. They used to be first. They lost the spot to Brazil. But I just want to emphasize is that with this new Trump 2.0, that whether US soybean will be put again as a negotiation tool between US and China is still much to be seen. But I think this time now the dynamics can be very different, because in a sense that Brazil over the past decade or so has actually been catching up very strongly. They are now the largest producer of soybean in the world. And in terms of export share to China, Brazil's soybean has actually contributed quite massively. Or in other words, I think China has slowly shifted away from US soybean and going forward to Brazil soybean to fulfill the demand. So I think that's crucial. So I think China is putting less reliance on clearly on US. So it's interesting to watch whether this time round how would Trump negotiate a deal, especially when it comes to US soybean with China, when China now is actually getting less reliance or putting less reliance on US soybean. So you can clearly see, I think the share of US soybeans to China has actually clearly dropped. It got aggravated during the first trade war. Now with second trade war coming in, I think that's really going to be begs the question whether Trump will really negotiate a better deal for the US soybean. Now, this is crucial. If you are trading the grains market, you have to watch out closely because any news flow regarding trade war that in relation to the soybean market, it can really move the market. We have seen that during the first term. So this time around, if there's a negotiation deal on the table, especially when it comes to soybean, the soybean market will definitely experience a lot of volatility. Now, besides soybean, there are other major commodities actually worth mentioning is the precious metal space, and in this regard, the gold market. Now, gold has clearly outperformed. You have now 3 weeks into the year. Gold has actually did tremendously well, and in fact, I think it rivals U.S. stocks performance as well. Now, gold clearly is a major winner is because the rush of safe haven asset, not only by central banks but I think consumer in general, given that the risk that they perceive with this new with this Trump second term administration is going to bring a lot of uncertainty in the market. I think consumers in general is also rushing into gold as a way to hedge those risks. Now, central banks clearly not only at the start of last year, I think 2 years back or 3 years back, especially China's central bank has actually been buying a lot of gold in the open market. Whether that is a strategy to counter the reliance on US dollar, that's remained to be seen. But I think because of central bank buying aggressively in the market, these are all supporting the major demand for gold and therefore the prices of gold in general. Now, if you are trading gold, you probably have seen how the gold price movement has been over the past couple of months. Now, if you compare the traditional, relationship between gold and equities market, is always an inverse relationship, which means that when you have high gold prices, normally it means the equities market is usually in the weakness or in the downtrend market, and vice versa. Now you can clearly see that relationship doesn't seem to hold. In fact, gold and US equity space are actually moving quite parallel and moving in line. So when you have high equities market hitting all-time high, you also can see the similar reaction in the gold market as well. So if you are trading based on this historical or past relationship, you probably will get caught because right now gold is on different dynamics. The demand for gold is actually pretty strong, coming from a lot of areas, especially the central bank. So the physical demand is actually what is supporting the prices for gold in the market. So as long as the demand is still strong, despite you're seeing strong equity performance, it doesn't really matter because as long as demand is there, people still favor gold, and that will push gold prices even higher. Now, if you just look at it again, the dollar relationship with gold prices, you can clearly see historical doesn't set any precedent at all. No, if you just look at historically speaking, the movement between the dollar and gold is usually quite inverse in the sense that you have a stronger dollar, that means you should see weaker gold prices. Now, in the past couple of years, we see this kind of relationship does hold, but in recent times, again, it doesn't because really the gold dynamics has actually changed quite fundamentally. No, I think the rush of safe haven, given the volatility and the risk in the market, is really making gold quite appealing, and therefore, whether it's consumer or hedge funds or funds in general, are really loading up on their demand for gold, and that causes a major support for the gold prices in general. Now, if you are trading a gold market, it's interesting to watch. I think this year is not only equities market experiencing volatility, it's also the precious metal, especially gold market. If you just look at this gold rally you are seeing, this bottom panel ATR measures the range of the market for gold. You can clearly see the ATR value has actually been rising since late last year. So you can, if you are trading a gold market, every day you're experiencing probably 10 to 20 US dollar fluctuation, which is pretty normal. During a range market, gold can trade lesser than that. So that shows you that when volatility comes back, usually there's an opportunity for you to be for traders to trade the market. But that also means that there's a lot of news flow that's coming into the space. So you really have to be mindful. If you are trading a gold market, it's always sensitive to economic news in US. So whenever there's US economic news announcement, that will really shift the dynamics in the gold market. Now, coming to strategies, I think I've mentioned clearly from the fundamental perspective, markets are, in US are actually on a strong footing. The key question is that, uh, technical wise is telling you that, the rally probably could face exhaustion in time to come. And during that time usually be a good opportunity for you to find pocket of opportunities. And how do we do that is to look at certain tools that we can use. Now, if you are looking at trends in the market, clearly now the market is on the uptrend in the US equity space and also the gold market. So the key thing is always in any trading plan, if you are using trend as a trading style, is to identify the trend of the market. There's many ways to do it. You can look at the trend visually by looking at the highs and the lows. If the highs are going higher, the lows are going higher, normally that indicates to you is an uptrend market, and vice versa. So you can look at trends visually, or you can also use tools like moving averages to plot moving averages. As long as the candles are both multiple periods of moving averages, that tells you market generally is still an uptrend market, and vice versa if the candles are below. So besides looking at moving averages and looking at things visually, one great tool if you are not familiar with trend trading tools is what we call Heiken Ashi. Now Heiken Ashi is one part of Japan's candlesticks, and it's a great tool for you to gauge trend in the market, especially during short-term trend in the market. And it actually assists you, if the trend is, if you try to identify trend in a shorter time frame, if you use a normal Japanese candlesticks, you tend to get a lot of mixed signals. By using Heiken Ashi, you can clearly see the trend illustrated by the color of the candle bars quite clearly, and therefore you can able to pinpoint the exact trend in the market during that time. Now obviously you can incorporate many other trend indicators like moving averages or directional movement index, which is a very commonly used trend trading tool as well. Now, besides identifying ways for you to enter and exit, I think the most important part is always to measure your loss using you can use many ways to get yourself out to manage your loss. You can use a fixed percentage. You can use support and resistance. There's many ways, but I think for me personally, I always use what we call the average true range, or rather the true range indicator, as a way to measure your loss. Now sizing is also one way to to manage your loss. If you are someone new to the market, or if you are new to the product, always start with smaller size, and from then once you are able to grasp the market behavior and dynamics, then you size up accordingly. So these are all key things that you really need to look at, especially when you are facing a period of higher volatility. Make sure you have plan in place, and especially your stop loss procedures whenever the market go against you. Now, just to show you some technical perspective, you just look at S&P 500. It's clearly on an uptrend. Reason being is because if you just plot the 50 period and the 200 period EMAs, you can clearly see the candles majority of the time are still trading above the 50 period EMAs. So it's telling you that generally the market is still an uptrend market. Now, if S&P 500 does face a bit of correction, the major support will be around 5,700. If it does break that, it's probably going to test a 200 period EMA level, which is about 5,003. So that gives you a very strong indication as to where your support, your first line and second line of support is. Now, same goes for Dow Jones. Now, Dow Jones is quite interesting because I think in the early part of this in this month, we can clearly see Dow Jones actually try to break below the 50 period EMA. It doesn't seem to sustain. In fact, once Trump was inaugurated, past couple of days, the Dow Jones actually make a comeback rally. It's now trading above the 43,000. So it's the key question is that can the momentum still continue? So it's crucial to watch. But overall, the trend in Dow Jones and the S&P 500 is still an uptrend market for now. So this is what I mentioned, using Japan's candlesticks and Heiken Ashi. Now, Heiken Ashi is a great trend trading tool is because if you just look at the chart on the left, and which is the Japan's candlesticks, and the chart on the right, which is Heiken Ashi, you can see that the identification color is very distinctive. So Heiken Ashi is pretty much a derivation of Japan's candlesticks. It's actually derived from Japan's candlesticks. There's a fixed formula. So you can obviously, now I think most of the trading platform does comes with Heiken Ashi candles. So in a way it aids you in a way for you to pinpoint when the trend change in the market. So if you just look at this two chart, you can clearly see if you're using trend, Heiken actually seems to be a better trend trading tool as compared to Japan's candlesticks, because Japan's candlesticks, you get a lot of whipsaw signals whenever the color of the candles changes. That tells you the momentum of the market also change. But in Heiken Ashi, you hardly see that, because that will reflect by the middle. It really reflects the middle of the Japan's candlesticks bar. So it needs to take a big move in order for the trend to change. So as long as this trend is still showing you persistent weakness or strength, it tells you the trend is still in place and you should be holding a position. Now, the reason why I chose Heiken Ashi as a trend trading tool is also because it's easier to compute and easier to identify. Unlike Japan's candlesticks, if you want to master Japan's candlesticks, you read Steve Nielsen's book. It's probably about 100 over configurations that you really need to know, and it takes years to really master Japan's candlesticks. Now, Heiken Ashi is slightly different. It's only 3 simple patterns that you need to realize. First is always the color of the bar, red or green. And in any of the color body bars, if you see let's say a green body bar, which is having an upper wick only and there's no lower wick, that tells you this uptrend is very strong. Same goes vice versa. If you see a red color body bars which is a lower wick and there's no upper wick, it's telling you that this downtrend is actually very strong. Now, if you see sometimes you see a green body bar but have an upper and lower wick, it tells you generally this uptrend is sustaining a bit of is probably going to be lack of momentum, and the strength of this uptrend is probably going to be weakening, because there's appearance of upper and lower wick. Same goes for a downtrend market. Now, another pattern that you just need to realize is something of a small body, almost like a doji style candles. Now, in this style of candles, normally it tells you, if you see this, especially in the uptrend market, it generally tells you that this uptrend is probably going to be exhausted at this point in time, and that usually be a good signal that there's a potential change in the trend in the market. So you have to watch out closely when you start to see, doji type candles, especially during an uptrend or downtrend market. Now, major difference, Heiken Ashi is only 3 major forms that you need to know. Whether how wide is the body, or whether the body is almost like a doji type of candles, is telling you that the reversal is going to come into place. Now, Japan's candlesticks is slightly different. You have so many other combinations, and therefore it's actually quite subjective in nature. So it's a matter of interpretation, how you see it. The certain pattern that's distinctive in the Japan's candlesticks configuration, and it has to be the fixed configuration. You can't miss out certain parts of a set. So it makes Japan's candlestick quite rigid in certain sense. Heiken Ashi is all about numbers. There's a fixed formula for calculating Heiken Ashi candles. You can Google it. So if you are using algo trading or automated trading, you can obviously program Heiken Ashi candles as part of your trading strategy. Now, Heiken Ashi is what we call a trend following candles, because it shows you the trend in the market at that point in time. Now, Japan's candlesticks, if you just look at most of the combinations that's listed, majority of them are reversal patterns. So if you look at Japan's candlesticks, sometimes the patterns configurations are more to reversal by nature. Now, Heiken Ashi is identified by color. Japan's candlesticks is by pattern. So just to show you the dynamics, so every time you start to see a red color, body bars with quite a white body bars, that tells you generally the downtrend is actually quite strong. Same goes for you start to see green candles. If the bodies are getting wider, that tells you this uptrend is actually going stronger. Now, this is a series. If you start to see series of red and green together and almost a doji type of candles, this is telling you that if you just look at the trend before, this space of region is an uptrend market. And if you start to see red doji type of candles, especially during a green candle, subsequent green candle bars, is telling you that this uptrend is probably losing its strength. Or rather, the market is heading to a pause or sideways market. Now, in sideways market, if you're using trend trading strategy, it's very difficult. Be on the lookout. If you start to see that trendy market starts to go into range bound markets, that usually be a good time for you to be out of the market, because if you're using trend trading tool, you can't really use it, especially when markets are ranging. So keep that in mind. Now, so that's Heiken Ashi. Now, Heiken Ashi is just pretty much candlesticks that show you a trend in the current time. Now, if you incorporate moving average crossovers, that's pretty much give you quite a good signal. So what we have here is actually 2 different period of moving averages. One we have a 9 period, the other one is a 20 period. and crossovers are quite easy. So the moment that the shorter term crosses below is telling you it's actually a bearish crossover, the market is probably going to hit lower. And if you can confirm that with red Heiken Ashi bars and the bars are getting wider, the body of the bars are getting wider, it's telling you this downtrend is actually going to gain momentum. Same vice versa. Here you can look at it. The shorter term crosses of both is telling you market is poised on the upside, and you can see long green color body bars is telling you that this market is going to get hit higher. So you can incorporate moving averages as part of a trading plan together with Heiken Ashi candles is giving you quite a good signal in the sense that that's potentially could be a trend in place at that point in time. Now, EMAs are also very useful as a line of resistance and support. So imagine here, you can see this behavior of the market. The candles are respecting the upper resistance line or the upper moving averages. This is the 20 period EMA line. So as long as candles doesn't break above, this downtrend is still quite persistent. Now, obviously, at this point in time, you can start to see green candles forming, and you can see there's a bit of bullish crossover on EMAs. This is where there's a potential market change, and it's actually breaking above the previous resistance. So it's telling you, not only as EMAs acting as a crossovers, your EMA lines can also act as a resistance and support level accordingly. Now, I just want to also introduce another trend trading tool, which is actually very useful. It's called a directional movement index. It's very useful to navigate, especially the equities, US equity space, the Dow Jones market, the S&P 500. Now, directional movement index is basically a trend tool that comprises of three different lines. One, we have the red line, which is what usually termed as the negative DI or negative momentum. The green line is usually the positive DI or positive momentum. So again, it works on a crossover. So the moment the negative DI, which is the red line, crosses above, it's telling you the market is probably poised for further downside. And if you just confirm with Heiken Ashi, the bars are getting red bars are forming, and body bars are getting wider. It's telling you, this negative momentum is actually quite strong. But what's crucial in the DMI indicator is actually the black line here. The black line here is what we call the ADX. Now, ADX is pretty much a line that measures the strength of the trend. So not only that we need to understand when the market trends, we also need to observe when the strength of the trend actually gets weaker. So when the trend gains momentum, when the strength is there, usually be in the market, but we should be out of market when the strength of the trend starts to get weaker. Or there's a point or period of exhaustion, and during that point, if you are still holding to a position, you should be out of market. So you can clearly see this in this chart, this black line here. As the ADX line starts to rise, you can see that this downtrend starts to gain momentum until you reach the peak here. Probably the peak here, you can start to see the market is actually going sideways. So if you're holding a short position in this market, you should be out when the ADX starts to drop, because that tells you that this downtrend momentum is actually losing its strength. And crucially to watch, if that when ADX starts to decline, is telling you that momentum is declining, and that's poised for a change in trend, and you should be watching out the next trade as to when the potential reversal in the market is going to happen. Now, for trade setup, so if you can combine all together, first thing is that you look at Heiken Ashi bars, and you just look at where the moving average crossovers are. So here you can clearly see that there's a bearish crossover and the red Heiken Ashi bars. So generally, this is a sell signal. And here you can clearly see that the minus DI, which is the red one, crosses above the positive DI. But the key thing is that the ADX starts to rise. So at this point in time, it's telling you that this downtrend momentum is just starting. As long as ADX is rising, this downtrend, it will have its momentum. Now, the reason I put an ATR is this is crucial. As I mentioned earlier, it's crucial for you to set your target profit level and your stop loss level. And how do we do that? So for example, you get a short signal at 42,542 on your Dow Jones index, and your ATR value is 120 points. If you work on the risk to reward ratio, that means you're looking at 240 points of reward and 120 points of loss. So this is how you set your stop loss target accordingly. So crucially, one thing to take note is that if you use ATR as a way to measure your stop loss, when ATR starts to rise because of volatility in the market, technically you're preparing to buffer a bigger loss. So some people may be uncomfortable with having such a big buffer by using ATR value. So you may use multiple of ATR. You can actually adjust your multiples based on the ATR value. But I think the key thing is that you must have a way to measure your loss accordingly. So if you have any other ways for you to stop loss, you can obviously employ it. Given that in any trading plan you must have a way to manage your risk. Okay, so this is what happens. I think we shorted around this level. The target profit was 240 points. It hit around this. The key question is that during the point where we get stopped out because our profit target achieved, you just look at ADX levels. ADX levels and DMI levels are still rising. So that means this downtrend is still quite persistent. Now, a plan is a plan. You should stick to your plan. If you have a plan that gets you out at this point, and if the market reach that point, you should be out of the market. There's always other opportunities in the market. So it's always, on hindsight, you can obviously say that you should wait until where ADX starts to peak, but you never know. The moment when this point hits, the market can actually reverse accordingly. So importantly, if you have a plan in place, follow your plan accordingly, or rather have a discipline enough to follow your trade plan accordingly. So this is what happened in the next few candles. So obviously you can ride the whole wave until the ADX points to you exhaustion. But again, like I mentioned, if your target levels is hit in terms of profit level, then you should be out of the market at that point in time. Now, again, this is for gold, a different set of example. Gold also show you show a sell signal here, given the fact that you have a bearish crossover. The Heiken Ashi candles are also red, indicating that a downward momentum is in place. Again, one I emphasize is that ADX level is actually rising. So when ADX levels is rising, it's telling you that this downward momentum probably is just starting to gain strength. And ATR level is only at $6 at this point, this period in time. So you can just work on your risk to reward ratio. Now you can clearly see, I think probably your profit target has hit. But what I want to share with you is that ADX is actually very useful to gauge the strength of the trend. So the moment when you start to see ADX starts to rise, it's telling you that there's momentum in the trend. And if you are holding on to the position, you should watch out when ADX starts to peak. So the moment you can see here, when ADX starts to peak, you can start to see this. The candles are getting smaller. Heiken Ashi is almost like a doji here, which is signal to you that this downtrend is facing exhaustion. And it's also green candles are starting to appear. It's telling you that potentially the market is going to turn. So that could be another different trade setup altogether. So it's crucially, if you combine the understanding of ADX together with trend identification using EMAs and Heiken Ashi bars, that's usually generate quite a good signals for you to interpret the market. Okay, now a bit of overview in terms of outlook where we see the gold market. Now, gold market is still clearly is still an uptrend rally. The short-term uptrend is still quite strong in the sense that if you just look at ADX levels are still above 30. Now 30 is not to say very strong uptrend, but it's still an uptrend and there's still momentum. Key to look at is that when this ADX starts to peak or when it starts to curve down, it's telling you that possibly that gold market may face a peak level at a short-term peak level at that point in time. So the reason I draw this support level is basically these are all moving averages support level, which is a 50 period and 200 period. So 2650 is a crucial support for gold market. If it does break that, I think the 200 EMA is worth to look at, because if it does challenge that, it's telling you the market is heading for further downside. Now, S&P 500, I mentioned, the recent rally is showing you a bit of sign of exhaustion, especially you look at ADX. ADX line is starting to decline. In fact, it's heading to 20 and below. When ADX value goes below 20, it's telling you market is heading sideways. There's no clear trend in the market. Now, in the past subsequent few days or so, we've seen this rally that we in the S&P 500. So once you start to see ADX starts to decline despite you're seeing rally in prices, it's potentially telling you that this rally possibly could not sustain itself in days to come. So watch out. I think S&P 500 could face a bit of resistance in the next couple of sessions. So if ADX starts to decline and holds around 20, it's telling you this temporary top is potentially could just be a short-term rally, and therefore the trend will probably change in time to come. Now, what's important is that if you just look at ATR, which measures the true range of the market. The volatility of the market is indeed very volatile in the first period, especially during the Trump 1.0. The ATR at that time is between the range of 50 to 100 points. That's quite massive. Now, if you just look at where we are after post-pandemic, the daily range in S&P 500 is easily talking about 150 to 200 points on a weekly basis. So that's huge. So that tells you that there is more volatility in the market space, and with more volatility, obviously there's more opportunity. But again, you must have always a way for you to manage your risk and loss, because when markets are more volatile, that means you can get stopped out quite massively as well if you don't have a fixed regime to get yourself out in case the market go against you. Now, this is showing you the Nasdaq index. So you can clearly see, Nasdaq is still pretty much on a strong rally. But again, the ADX is pointing to you the market is heading to nowhere, despite us saying, strong rally in the Nasdaq index. But I think the technical indicators are pointing to you that the market is probably potentially may face a bit of resistance in the near future. So I almost concluded on a technical part. I just want to, if you're, I also did mention on gold. So I just want to mention a new contract that's launched by CME early part of last week. It is the one CME 1 ounce gold. You want to get more information, you can obviously talk to Philip Noah guys. They probably can give you more information on that. But I think it's worth to look at this contract. If you are, if you find that gold is getting more volatile, and trading on whether it's on the big size or the medium size contract could be a bit heavy because of margins and obviously the price fluctuation. I think it's a good way to start using a smaller contract. This is a very small contract. It's only 1 ounce. So technically it's pretty much, it's all talking about how you size up. So it's a good way to start or to gain exposure in the gold market, especially during these volatile times. If you're seen in the gold market. So, if you want to find out more, do keep in touch with Philip Noah. I think they can give you more information on this new contract. So I'm just going to end here with a quote. If a lot of people have asked me this, what's the key thing to really be successful in trading or to have the longevity in the trading world? I think the key thing is always about risk management. It's never about making profit. Profit is always secondary. The key thing is always make sure that you are able to control your risk and survive for another day. Because like I mentioned, there's always a lot of trades. You miss one, there's bound to have another opportunity in the market. And now with market so volatile, they're bound to have plenty of opportunities. But always make sure you must define your risk management, because if you can't define that, when markets are very volatile, it can really be a make or break for you when it comes to trading the markets. So I just want to share 2 quotes. Paul Tudor Jones is a very good trader himself. He always mentioned this: don't focus on making money, focus on protecting what you have. And another one is Tom Hogarth. I'm not sure how many of you were here and read this book called Best Loser Wins. I think it's a great book on risk management and trading psychology. So if you are new to trading, if you have the time, do check out this book. And I just want to quote a quote from him, which is, he always said his belief in defining his risk and is never belief in defining the reward. Because once you manage your risk, your reward will come eventually. So with this, I'm just going to end here. I'm just going to take any questions from the audience. I'm just going to give 20 seconds. Feel free to post any questions in a question and answer question box, and I'll address it accordingly. Okay, I can see some questions coming in. So I'm just going to address the first question. So the first question one of our audience asked is, Magnificent 7 stock valuations are very stretched. Should we wait for pullback or correction to enter for investment? Historically, it's fairly a bearish month. Now, I think I just like to address the first part of the question, whereby obviously we are all aware that the valuation of Magnificent 7 stocks are very stretched. If you just look at pure valuation wise, sometimes it just doesn't make sense. But then again, the earnings are still justifiable for now. And again, they are in a very important sector of the economy, which a lot of fund managers are piling their investments in, which is the AI and technology space. So I think with the momentum, with the with the stripe is still in the technology space, there is still room of growth. Now, whether is it an investment if this seven counters suffer a pullback. Now, I mean, I can't really comment much because I'm not into investments, into specifically investment on these tech companies, because I'm looking at the index futures in general. But I would say this: the Nasdaq index, you can clearly see, I've shown to you earlier. The index itself is still pretty much trading at all-time high levels. So there's still the narrative of the AI, or rather the tech companies are still there. It's still pretty much a positive narrative. So as long as the narrative is still positive, there's still room of further upside. So any pullback could be potentially be a opportunity for you to take a long position, because the overall trend of the Nasdaq, not only Nasdaq, you look at S&P 500, the Dow Jones, it's still an uptrend market. So like I mentioned earlier in the presentation, whenever the uptrend market, always find opportunity for you to long rather than short. So any pullback could be potentially be a good position for you to take a long position. Now the second part of the question is, historically, is February a bearish month? Now I can't, if you look at seasonality wise, I didn't observe that on Nasdaq specifically, or any of the Magnificent Seven companies in terms of their seasonality. Now if you just look at Dow Jones, Dow Jones normally in February is usually a weak month, but not so weak. It's generally, I would say, out of 10 years, probably you start to see 6 years, which is a down month for February, and 4 years is a strong month. January is a quite a prominent month. January usually is a good month for majority of the US indices. This is based on seasonality. So whether that will continue this month or not is still much to be seen. But February wise is quite mixed, in the sense that probably you get a bit more bearish in terms of seasonality pattern. But there's no clear distinct pattern. Seasonality doesn't always work. If you look at it historically speaking, you should expect, out of probability of 60%, there's the chances that February could be ended negatively for the month. But again, it really depends on fundamentals, on economy, on the news flow. Okay. Okay. Okay, in your earlier charts, you talk about institutions hedging a market. May I know how were you able to identify when and that happens? Now, this is a good question. It's very difficult, to be honest. I think one key tool is that, no, if you just look at VIX, which is a fear barometer, and when markets fear gets elevated, people rush into VIX because they need to buy protection. They buy puts, and that will be indicated by rising VIX as a protection. So now you can see that despite you know US equity indices hitting all-time highs, in technically VIX should be trading at all-time low, but we don't see that. So that tells you, generally, I think fund managers who are holding huge positions in the equities markets are also doing hedging, just as a way to pay the cost of protection. In case of any big swings in the market, they are well protected. So I think that's one way to look at it. But we can't specifically identify, or rather to have a specific data in order for us to gauge, or whether institution is hedging that particular market at that point in time. But I think VIX as a good barometer. When you see rising VIX despite all-time high equities market, it's also telling you that people are also buying VIX as a cost of protection. Okay. Um, this question is, what are the EMA length you're using? So in most of my example that I use, whether you're talking about equity, US equity index futures, or whether you're in the gold futures market, I'm pretty much using the 9 period and the 20 period EMAs, using on the 30 minutes to an hour. Now, in terms of time frame, I wouldn't recommend anything below the 30 minutes time frame, because especially in whether you're trading Dow Jones or the Nasdaq market, anything that's below 30 minutes time frame, you're getting a lot of whipsaws. So I will highly recommend, if you are using you are trading on an S&P or Dow Jones, look at a wider time frame, which is, I think, an hour will be sufficient enough, and towards you can go in the higher time frame. Anything that's below, especially below 30 minutes, 15 minutes, you tend to get a lot of mixed signals, and using Heiken Ashi, you get a lot of false signals in time to come. So I think that's generally the periods I'm using. 9 period and 20 period is the key periods that I use, especially when I look at these type of markets. Uh, will you see another year of bull run for gold? Now, I believe no volatility in the market is always beneficial for gold prices. So as long as volatility is there, Trump is definitely going to be he's definitely going to usher in more volatility. It's not going to be a year where we start to see more stability in prices. I don't think we start to see more stability. In fact, we get more volatile periods, and when that happens, gold tend to benefit. Now, one thing to caution is that technically gold is actually due for correction, and it's just a matter of time. So always watch out on your chart. Whenever ADX starts to pull back, in the recent uptrend rally, be careful. Usually that be the first point where market gold market tend to face weakness. So the question of whether is it another year of bull run for gold, it's hard to tell. But I would say this: that if Trump is definitely going to mean more volatility in the market, and that indirectly is going to benefit gold. Okay, I'm just going to take two more questions. Then I think that's probably because we are just a bit out of time. So is this strategy for swing? So what I mentioned here is that using Heiken Ashi, using moving averages, and using the DMI trend tool is, I wouldn't say it depends on the time frame you're looking at, but if just look at the time frame I'm using it's actually not a swing. It's more of looking at when the trend pattern change. Swing will have a longer time frame. So it's already down pretty much to the time frame you're looking at. So as a for me as a trader that trade full time, we are really looking at positions on a daily basis. So we can't really hold positions on overnight basis. Where swing, if you're looking at swing strategy, we tend to hold positions longer than a day. So I think that's usually be challenging, especially for you know uh, a full-time trader that really we need to clear our positions ahead before the next session starts. So swing strategy is this strategy is actually pretty much more onto the shorter time frame analysis. But again, you can obviously apply for longer trend analysis as well using the same uh, tools that I just mentioned: the Heiken Ashi, the moving averages, and also the DMI tool. Okay, I'm just going to take one last question. Um, Can you also share why you are using EMA 9 and 20 in combination with DMI? Okay, that's a great question. Now, if you just look at some of the examples, I'm just going to go back to my chart just to show you an example. Um, if you just look at this goal setup. Now, the reason I use 9 and 20 and also DMI is a good question because first thing is that crossovers you can obviously incorporate with Heiken Ashi. That gives you a very good signal. Now, the DMI tool is mainly for the ADX, which is the black line. Now, you can also use a DMI crossover, but if you notice that the DMI crossovers and the moving average crossovers, they give you very similar signals. So in the reason I incorporate DMI is mainly for the ADX, which tells you the strength of the trend. So if let's say this is the downtrend in time, in this period of time, the ADX will actually measure the strength of this downtrend. So if ADX starts to rise, it's telling you, okay, this downtrend is actually gaining momentum. But it's also crucial to watch if if ADX doesn't seem to rise, but this Heiken Ashi bar is showing you red, then really you should look at the EMA crossovers, which plays more priority. So EMA signals and the DMI positive and negative, the red and green line signals are pretty much overlap. So in a sense that you may actually if you use EMA crossovers, you don't need to use your positive and minus DI crossovers. You just need to focus on the ADX, the black line. But it's good to just incorporate both. But it's a good question because generally the DMI crossovers and moving average crossovers are actually giving a very similar signals. So in a sense, it's overlap. So with that, I'm just going to end here. I'm just going to pass to Min Hui for any for any further updates that you have on your end.
All right, so due to the time constraint, we have to end our Q&A here, but please feel free to drop any more questions you may have, and we will get back to you via email. And thank you very much for the insightful session, David. Before we end the session, allow me to get my screen up again so I can share with you this exclusive promotion we have for US stock index futures and options. So you can turn the insights you've just gained from this session with David into action and trade CME US stock index futures and options with Philip Nova at a commission of only 98 cents. And eligible contracts include indices, gold, and crude oil. You can take a screenshot or scan the QR code to check out the full promo details. And with that, we have come to the end of the webinar. Thank you again, David, for the sharing, and thank you everyone for your time tuning into this webinar tonight. Feel free to send in your questions via the survey that will be popping up after the session, and we will get back to you as soon as we can. We'll also be sending everyone a link to today's webinar recording so you can watch it again if you'd like to. That's all for today. Thank you and have a good night.
Thank you.